I think all these you could hold for 5 years. There could come a time when the precious metals have run up substantially and these things are not cheap anymore. And at that point in time, I could see that happening 3, 4, 5 years out. At that point in time, they would not be as compelling as they are right now. But I think right now they're quite compelling.
Welcome to the inaugural episode of 3 Ideas. I'm Samuel Burke, the managing editor at Real Vision. And before we get to the 3 Ideas with our guest, Larry Lepard, I just want to tell you a bit about this show and the idea about it, because it actually comes from you guys, the Real Vision community. We've heard over and over again, not just in the comments beneath the videos, but also I've talked to you guys in person at Real Vision events, and you say that you want actionable ideas. There are a lot of big names, a lot of big ideas that aren't always accessible to the entire Real Vision community, which is why we have this show now. 3 Ideas. It says it right in the name. 3 ideas for investing, but it's not investment advice. And I'm not just saying that because it's legal mumbo jumbo. We at Real Vision, we don't know what your risk appetite is, how much capital you have available to invest, and we don't know how you want to allocate your portfolio. So do your due diligence. You can take these ideas, do your research, and figure out what's best for you. So with that, I want to introduce our first guest, Larry Lepard. He is the managing partner and founder of Equity Management Associates. He focuses on precious metals. He's a big believer in gold and silver, specifically mining companies. That's his outlook. Larry, thanks so much for being on the first episode of 3 Ideas. And before we get to those 3 ideas, I just want to get your global macro outlook. We're coming off of big announcements from central banks, not just in the US or the Bank of England here in the UK, all around the world. So tell us what that means for this industry at large and the industries that you look at.
Yeah, first, Samuel, I'd like to thank you for having me on your show. I'm a big fan of Real Vision, subscriber. The global macro, right? What a mess. It's extremely volatile, and I don't think we're in uncharted waters, and nothing new there. My belief is that what we're slowly seeing is a change from a system where the central banks could control everything to a system where the central banks are not going to be able to control everything. And I describe it as kind of monetary chaos, and we're gonna swing back and forth between high inflation and the risk of deflation. And so, this is the problem that the Fed is faced with, and as we all know, they've kind of packed themselves into a corner right now. And with that as a backdrop and understanding the way that democratic and other governments work, my belief is that they can never stop printing. And although they may be trying to right now, and for some time they will, eventually the damage and the pain that's going to cause are going to force them to go back to where they were before. And that's because the system is built on ever increasing credit. And the alternative is a deflationary depression. And so, although we're in what would look like a deflationary impulse here, a very big one, I think that there'll be a time when they'll have to change policy because the conditions will demand it.
And Larry, when you say the system which they used before, what do you mean specifically?
Well, I mean the monetary system. The way we've constructed our monetary system using leverage on leverage, and the way the governments operate using continual growth in sovereign credit. And so what we're really encountering right now, in my view, is a sovereign debt crisis. It's the bursting of the everything bubble that got created. It all was kicked off when they went to a ZIRP, 0% interest rates from 08 to 015. I mean, that was a crime against, capitalism in a sense. If you don't have an interest rate on the money, then the money has no value intrinsically. And so it led to all kinds of capital misallocations. And now we're seeing the effects of that policy come home to roost on all of our assets. And it's what's making the environment incredibly difficult for all investors, sadly so. But, you can't undo. I mean, what I see is very similar to what happened in 29. I mean, people say, well, I don't want to have a bust. Well, okay, you shouldn't have had the boom, the big boom that was created, NASDAQ up 16x from 09. I mean, it's got to be corrected. And, there are implications, right?
This is all crystallized on a tweet that you have pinned to the top of your Twitter account. 2 simple lines. One says gross domestic product. The other one, all sectors, debt, securities, and loans, liability level. I think you've made it pretty clear why you've had that tweet pinned up there since then.
Yeah, that's right. I mean, it's you cannot increase debt forever because you can't service it. And so we were in a big deflationary period for the last 40 years, and I think that ended on March 2020. I mean, you had, the 10-year was at 43 bips. I mean, my view is that we are now in a new world, in an inflationary environment, and that it will only continue to grow, the inflation that we currently experience, which is not to say there won't be periods when it slows down. I mean, I think it's going to be very volatile in both directions. It's a treacherous environment for investors, but the things I conclude pretty solidly are that bonds are a bad place to be, and that over time, I think commodities and equities that are equities tied to things will do better than equities that are tied to growth and ideas, because I think we'll be in a stagflationary period, and there will not be a lot of growth, and that's my belief.
So that sets out very clearly your global macro outlook, but
Right.
how does that apply to the industries that we're about to talk about?
Yeah, if you look at it, so the conditions I think are going to be very similar to the 1970s. I was a teenager at that time. And in those conditions, the bonds were just a total disaster. I mean, there was no worse investment than bonds. Equities were very choppy. They were pretty much a disaster. I mean, you kind of held your purchasing power, but barely. And the areas that did extremely well were commodities. I mean, the two top performing industry categories in the 70s were the oil stocks and the gold stocks. And of course, I focused on the gold stocks, and that's the reason why. My macro outlook informs me that gold stocks, I think, will be the top performing asset category in the next 10 years.
I mean, I've been looking into these companies that we're about to discuss. And as I look at them, it seems like they maybe all are in a similar space, in part because of what the Fed is doing right now. So where do you see this entire industry inside that global perspective?
Well, to give you some context, gold did extremely well, and the gold stocks did extremely well in 2020 as a result of the money printing and the inflation that was going on. The Fed was at the time quite accommodative, and that was very beneficial to assets which take advantage of the inflation. So they reflected the inflation that we're now experiencing. They could see it. As we all know, the Fed has now decided to try the Volcker playbook, and so the theory is that they're going to get inflation under control. Inflation is going to come down, and you don't need gold, and you don't need gold stocks. That's the theory. I think the reality and the practice is that they're not going to be able to control inflation, that ultimately their activities are going to cost something to break, and that when they do, they're going to have to come back in with more money, and there will be more inflation. And so the bet we're making is, in my opinion, that the central banks will not be successful in what they're doing. But to your point, where we are right now, we've just had a huge drawdown in the gold stocks. I mean, my fund was up 98% in 2019. It was up 122% in 2020. I've given half of that 2020 run back throughout 2021 and 2022. These things are volatile, and basically, when you're looking at these assets, they react to what they think the future price of gold is going to be. They're leveraged bets on gold. I mean, you could just buy gold, and gold, people knock it, but it's actually one of the better performing asset categories. Other than cash, it's probably the best performing asset category this year. I suppose some commodities have done a tad better, but bonds are down 20%, stocks are down 20%, gold's down 6% year to date. We're in a correction, I guess is the best way of saying it, and therefore I think our video here is rather timely in the sense that I think people who buy gold stocks right now, almost irrespective of which ones, are going to be pretty well rewarded as we enter the next upwave of inflation. And I think that's coming. I don't know when. We talked about this pre-show. It's impossible to know when, but I think it is coming.
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you.
Larry, let's get into the three ideas. Let's start out with your first pick. That's Equinox Gold. This is a Canadian company, dual listed on the NYSE, EQX there. Tell me about the company, but also tell me from the get-go, I assume that you have exposure to this company. You're invested?
Yeah, I have exposure to all three of these ideas. Obviously, this is what I do. My people pay me to pick the best names, and I've tried to pick the safest, largest names, and then two of the safest, largest names, and then one that's a little bit more speculative, but I think quite safe or good. The first one's Equinox. So this is a billion-dollar market cap company headquartered in Toronto, based in Canada. Ross Beatty, who's kind of a mining legend, a billionaire built on mining stocks, is the chairman and owns 8% of it. So that's always a nice thing. And I think they have one of the best management teams in the business. And that's extremely important in this area because I should say gold mining is a difficult business. You're breaking rocks and Murphy's Law applies. And there are a lot of things that can go wrong. And sometimes they do. It's just a matter of how it works.
I mean, if we take a look at this company, it was trading at $8.90 back in April, and now we're trading somewhere around $3.50.
Right. So to me, it's an incredible bargain at these levels. And this is a reflection of the macro that we were speaking about earlier, right? I mean, everyone thinks that the Fed will be successful in containing inflation, and therefore you won't need gold stocks. I personally think everyone's incorrect in that assumption, but obviously that's why they're markets. So these guys are based in Canada, and they have 7 producing mines, and they're in safe jurisdictions, and that's important too. I mean, when you're picking gold mining stocks, there's some companies that operate in countries that are not friendly to gold mining or that can seize mines or tax mines, and so I think Ross has been rather smart here. His portfolio of companies is in the United States, Canada, Mexico, and Brazil. So in my opinion, those are all safe countries, even though South America is a place where, well, there are others, but South America is one of the places where there's some countries that are uninvestable, in my opinion. And so he's got 7 operating mines, and then he's got 4 growth projects and expansion in those existing mines. And I think the most interesting thing here to me is, to me, the lowest risk category of investing in gold stocks, and they're really 3 buckets, right? They're the producers, they're the developers, and the drill stories. The producers are the safest because they have positive cash flow. When you have positive cash flow, you can't go bankrupt, right? The development and the drill stories, they all need to absorb cash to hopefully produce gold. And so this is a producer. In this year, they should have $250 million of EBITDA with a market cap of $1 billion. That's 4x EBITDA. That's not bad, right? Compare that to Apple or some of the others out there. But more importantly, and as I was saying, I think the lowest risk category are producers that are growing, because you could buy Barrick or you could buy Newmont. The problem they have is that they have 5 million ounces a year of production. And remember, a gold mine is a wasting asset. You're pulling gold out of the ground. Once you've done it, it's not there anymore. You got to find more gold. So it's like being an oil company. You're always looking for new resources, so you're always exploring. And in my view, when you're smaller, it's easier to replace what you mine, because if you're Barrick or Newmont, it's hard to find 5 million ounces of gold a year. I mean, they're barely managing to do it in some years. They're not in others. In this particular case, Equinox has been able to grow their resources very nicely. They currently have all category resources of 30 million ounces of gold. That's pretty interesting, because if you take the market cap, divide by 30 million, that means you're paying $33 for every ounce of gold in the ground. Now, if they were above ground, they would be worth $1,700. Obviously, the difference is you got to spend money to mine them. And so, the thing I think that they've done a nice job with here is they've got a nice basket of assets, and they've got a nice growth pattern. This year, they'll mine 580,000 ounces of gold. And next year, a few years out, I think they're going to get to close to 1 million ounces of gold. So that's 40% growth in the underlying gold that they're mining, and that's unusual in this industry. So this will, projected Bloomberg consensus projected EBITDA in 2024 is $500 million. So that would imply that they're selling at 2x 2-year out EBITDA, which is pretty cheap. So it's a good situation, and typically the way you value a gold company, or one of the ways you value a gold company, is you put a price on each ounce that they're mining. So gold companies tend to be worth between $4,000 and $6,000 per ounce of gold that they mine. And if you applied that, I forgot to do it before the interview, but if you apply that to the 580, even if you apply the low end of the range, $584,000 an ounce, that would be $2.3 billion. So that's a double right there at the low end of the range. And then, I think the number of ounces they mine are going to grow. So I think it's got a lot of potential as it re-rates higher. And I like the management team a lot. And I like their odds of doing it. There's some reasons why it trades cheap. One of them is they've got a development project called Castle Mountain. And people are worried about cost overruns there. I'm not. again, because of the way they've done the project and the way the management, the skill of the management. But that probably is part of the discount in the stock right now. But I view it as an opportunity.
And I'm curious, I think you've made the why now very, very apparent, though I should note, I was reading a note earlier that put lower support at about 325.
Right.
But when you look at your time horizon here, that's one of the most important questions that Raul always talks about.
It really is. And that's a great question, Samuel. And that's important with these stocks, right? I mean, I thought it was cheap 3 months ago, got cheaper, right? And you could buy it here and it could get cheaper still. So I think you got to keep that in mind. And one of the things I advise when people are entering this area is to dollar cost average and, going into them, because we don't know when this will turn. I mean, I think the next run up is somewhat dependent upon gold believing that the Fed is going to ultimately have to accommodate the world by not being as monetarily tight as they currently are. And I think that's an almost certain event if one looks at the math very carefully and the federal deficits that we're running and the cost of servicing those deficits. So that, in my view, will create a higher gold price. Gold will go through 2,000 and all these stocks are going to go bananas. But I can't tell you if that happens tomorrow or if that happens in 3 months or if that happens 6 months or maybe as long as a year. I kind of doubt it'll be as long as a year, but it could be. And so I think it's important if you buy something like this to have patience to let this thing play out over a couple of years. I'm pretty confident that, I mean, unless the Fed is successful at what they're trying to do, and I suppose it's possible, I'm pretty confident that 2 or 3 years out from now, this is a much higher price on the stock.
Larry, I want to ask you, what is the thing that's most likely to upend your view on this idea?
The fundamental view on this particular company, boy, not much. I mean, I like the company's a damn good company. I mean, I suppose if Canada or Brazil or Mexico decided they wanted to seize the gold mines, that would be a real problem, right? And that's always a risk. I mean, these things are, they're literally pulling money out of the ground, and governments are always very hungry for tax revenue, et cetera. And corrupt governments have seized gold mines in the past. We can all debate how corrupt these 3 governments are. That's a different question. But I think that's really the biggest risk, is the governmental risk. I mean, the nice thing, when you've got 7 mines operating, you've got diversity, and that's partly why, you want to, in general, newbie investors in the gold space want to tend to stick to bigger companies, because the fact that they have a lot of properties reduces the risk of one property going bad. Remember, I spoke earlier of Murphy's Law. I mean, things happen in mining. Mines flood, the grade taps out. There are all kinds of, you have cost overruns, et cetera. The mining business is not a simple business. It's a difficult business.
And I'm just curious about Brazil. I mean, you talked about their exposure, U.S., Canada, Mexico. We'll talk about Mexico a little later on, but with Equinox having the exposure that they have in Brazil, and I think of the fairly wild political leaps from the last president to the current one in the lurch to the right, I'm surprised that you say that Brazil is such a sturdy choice here. But in terms of mining, I mean, this is the field that you know.
Yeah, well, you're right. I mean, Brazil, I mean, it's not perfect, and neither is Mexico, by the way, and for that matter, neither is Canada. But it's my belief the mining business in Brazil, pays a lot of taxes and pays a lot of royalties, and we haven't seen anything in Brazil that would imply that you're not seeing the kind of problems in Brazil that you're seeing in Peru or Chile or Ecuador. In general, they're taking a live and let live approach. And recall that the thing that's a counterbalance to the governments getting aggressive on these companies is that these companies pay governments a lot of money, and the governments do not know how to mine these deposits. I mean, Venezuela seized all their mines thinking they were going to get rich, a bunch of years ago, and it didn't work because they didn't know what to do with them. So, it's not risk-free, obviously. But I think Brazil. The other thing to keep in mind with some of these South American countries is politically, like in many places, they talk tough about a lot of things, but at the end of the day, they know there's money coming out of these mines that they need, and so the rhetoric is designed to win votes, but behind the scenes, the activity is not that threatening.
Okay, so I want to shift gears now to your second idea. This is Osisko Mining, another Canadian company. You'll see that theme here. This is a development story. And you say this is a company that's run by what you call Canadian mining royalty, and there's a big focus in Quebec right now. So tell us about Osisko.
Yeah, Cisco is really, it's probably one of the best deposits in the world. And that's, what really counts in mining is the deposit, the size of the deposit, and the grade of the deposit. And grade is the measure of number of grams in a ton of ore that you mine. And there are mines that operate at a grade of zero point 0.4 grams per ton, and 15 or 20 grams per ton is kind of lights out and very rare. This company has an enormous deposit. They have 8 million ounces of gold, and their grade is 11.4 grams per ton. That makes it one of the 5 or 6 best mines in the world once it starts operating. It's not operating yet. It's run by what I consider to be probably the best mining CEO I've ever met, a guy named John Brzezinski, who helped discover and daylight and produce the largest mine in Canada, which is the Canadian, one of the 2 largest mines. It might detour maybe slightly bigger, the Canadian Malartic mine. And so, the guy really knows what he's doing, and they've really drilled out a beautiful deposit, and the economics on it are quite compelling. They are not producing yet, which represents a risk, and yet the economics are so strong, and they have so much cash on the balance sheet and no debt, that I have very little doubt that they will be able to easily finance the ramp up to production. And I just met with John at Beaver Creek, the gold mining show, and he told me he's highly confident that they're going to have first pour in the first quarter of 2025. So that would imply we've got 2 years where they are not producing gold yet, but at that point in time, they would produce 300,000 ounces of gold, which, if we apply, the metrics we were talking about earlier, and the gold price stays in this area, goes slightly higher, it makes this company worth about $4 billion. And right now, the market cap is $650 million US.
If we pull back and look at this company, it's come off highs of about $5 Canadian dollars, of course.
Yeah.
OSK is the ticker. We're looking at 277 now. So if it were to go lower, would you view that as an opportunity?
I view it as a buying opportunity. I doubt that it will go lower, but it could. It's pretty well understood. And, it's cheap at this price, only if you really understand what the asset is. And it's hard because you can't multiply by cash flow here. But, you have to understand geology and just how rare large deposits of this quality are. And he told me when I was there, they've done one of the things you do in mining is you do reconciliation studies where you say, okay, we've drilled out this area and we think it's got, a grade of 8%, 8 grams per ton. And then you go down, and he's got an underground decline of 12 kilometers already. They're already basically setting the mine up. I mean, he's building it. And he did 2 of these studies where they had the block model that showed a certain grade of ore underground. And they pulled them out in the reconciliation. I think one they exceeded by like 30%, the other exceeded by like 70%. So, I mean, which implies that they've been conservative in the numbers that they've estimated. And that's why I think he's one of the best CEOs out there. The good CEOs in this industry, they underpromise and they overdeliver. And then what that leads to is the stock doing extremely well because people know that they can kind of trust the guidance coming out of the company. Some companies, even pretty good companies, occasionally will overpromise and underdeliver, and then the stock really gets in a hole and it's hard for it to get out of there. And so the thing that, I think I said it to you in the pre-show. I mean, if I had to pick one stock that I was going to give my mom and my kids, and, I was going to quit investing and say, wake up in 10 years, you'll be good, you'll feel good about it. This is it. I mean, there just aren't any deposits that look like this. This company is going to be worth billions and billions of dollars, in my opinion.
And you just mentioned 10 years. When we talk about time horizon with the first company with Equinox, you talked about 2, maybe 3-year time horizon. That's a producer story. But here, this is a development story. So would the time horizon be longer then?
It is a bit longer with the development stories because you got to daylight them. And the producer stories, they have to keep producing what they're producing year after year. And this will become a producer. But I guess the point, the first one had a bunch of mines, none of which looks like this mine. I mean, this is really, when it's all said and done, if we have a bull market in mining stocks, I mean, this could be Microsoft, right? I mean, this is, to my way of seeing, it's just a really, really high quality deposit. there aren't many of those in the world. I mean, there are probably 5 that look this good, and that's why I like it so much.
And what's most likely to make you wrong in this scenario? I mean, I don't think it could be a
Yeah, well,
politics situation in
yeah,
Canada.
yeah. The geology, there's not much doubt about that. Most smart geos totally agree with my view on that. I mean, I think there is a risk, although I think John has been quite conservative, and I think they've been careful in budgeting in terms of what it's going to take to build the mine. There have been several cases recently of big capex blowouts, which is to say people trying to build mines and they discovered it cost them much more. I mean, in an inflationary environment, diesel's up, explosives are up, steel's up, etc. And you've had a couple of famous companies that IM Gold and Argonaut, both of which I own, blow up because the capex really blew out. And I think there's a chance the capex will go higher here. Capex is in the $500-600 million range, recently estimated. So I think he's got the right numbers in there. But let's say it's 700 or 800. I mean, in the context of a mine that will be worth 3, 4, 5, $6 billion, if it costs 700 to build it instead of 500 to build it, it's not going to be the end of the world. It's obviously not a good development. But
and Larry, in this environment with inflation really affecting those capex, capital expenditures, how often do you want to see updates from companies more than just their quarterly reports?
Oh, absolutely. And all these companies are very good about it. And some of them will even, yes, on a regular basis, monthly, quarterly, and they do. I mean, they do. The good ones do. And that, again, that's how, it's very important. If people are looking at this area, it's very important to be a stock picker and to try to stick to the very best names. I mean, the industry indexes will do fine in the context of a rising gold price. But within that, there are names, and that's why having professionals who are familiar with the area help you in this area is worthwhile. There are names within the group that are just significantly better than others. And I think this is, as you said, you asked for my 3 top picks, and this is one of my 3 top picks.
And as we get into number 3, I just want to flag, don't stop watching right after number 3, because there's going to be a little twist in the story that Larry's going to give us. But number 3, your idea is around Guanajuato Silver ticker. Guanajuato is a city in central Mexico. It's obviously silver. It says it right in the name. We're talking about GSVR, traded in Canada. Here's a company at highs in 2021 around 70 cents. Talking Canadian dollars. Now they're at about 37 cents. Tell us about this company. Clearly, the exposure's in Mexico.
Yeah,
I'm curious about
this is an outstanding company with enormous upside leverage, probably larger than the other 2 in the sense that, I expect both of those to very easily be 5-baggers. I mean, to me, this could be a 10 or a 15-bagger, but obviously there's more risk associated in a single company, situation, and you're making a bet on Mexico, which I think is sound. The story here quickly is that James Anderson, a gentleman I've known for 15 years, has teamed up with a guy named Ramon Davila. Ramon built most of the mines. He was at First Majestic for most of his career, and First Majestic is one of the largest, if not the largest, very well run, by the way, and I like it and hold it, silver company. And so he was their CEO, COO for a long time and built all of their mines. He left them and he came over with James, was able to convince him to join him and to build Guanajuato. And in a very short period of time, only 3 or 4 years now, 3 years now, they were able to buy an asset very cheaply from Endeavor Silver called El Cubo, which, by the way, El Cubo had paid, Endeavor way back when paid $200 million for El Cubo. They sold it to us for $15 million because they had mismanaged it. And we got El Cubo going in the right direction. And then more recently, they bought the Guanajuato assets from Great Panther. These are assets that were valued at between 80 and 100 million. Great Panther was in financial distress, and James was able to buy them for 15 million. So what he was able to do was more or less, actually more than double the size of the company. He had 1 mill and 1 mine at El Cubo, and from Great Panther, he bought 2 mills and 3 mines. And so now he's got 3 mills and 4 mines, all in the Guanajuato area, and there's a ton of synergy there. And so what he's been able to do, he's got it running again and running well. His cash cost is running at about $14. So in a $20 silver environment, that's $6 an ounce that he's making. And in July, he did 144,000 ounces. And he just informed me on the phone last night that in August he was up 80%. So he did 256,000 ounces in August, which is a 3 million ounce annual run rate, which at $6 a margin means he's got EBITDA of $18 million on a $17 million story, or $17 million market cap US, or $77 million market cap US. He intends to exit next year at a 6 million ounce run rate. I think he can beat that, but that's what he's aiming for. At $6 an ounce, that would imply EBITDA of 36 million for 77 million of market cap. It's 2x. And, I think he can build this into a 10, 15 million ounce a year producer. And I also think he can improve the margins over time. So, it's a really good story with a really good team. I mean, they bought these assets from Great Panther. 7 days later, they were in one of the Great Panther stopes mining ore. When they bought the first mine, the cash cost was 22. He's brought it down to 14, and he thinks there's a little bit more that he can bring it down. So, to me, this is, and the other thing, I don't know how much people listening are aware of this, but there's a lot more leverage in silver. There's when gold goes up 10%, silver goes up 30%. And, I believe that silver is not going to stay at $20. I believe it's going to go to $30. So, silver at $30, cash costs at 14. Now you're making $16 an ounce. Multiply 16 times 6 million ounces. That's a lot of profit for a company that's valued at $77 million. I mean, the typical rule of thumb in the silver industry, if you go look at the big guys, they tend to trade at about $70 million of market cap for every 1 million ounces produced. So, we're already producing 3 million ounces. That would imply that if we were a big guy, which means we're safer and, et cetera, had kind of characteristics like them, that would imply a couple $100 million market value, and we're trading at 77. And we get to 6 million ounces, take the 70 times 6, that would imply $420 million of market cap again for 77 million. So there's a lot of leverage here. What can go wrong, obviously, if the silver price goes down? I mean, at $14, the margin's not that large. And, $17 silver price, and this thing's going to, they'll be fine. They won't run out of money, but it won't have the upside that we expect.
And I'm curious about the political climate in Mexico. Unlike Brazil that we talked about just before that went left to right, Mexico's gone right to left. You have AMLO, as he's known in Mexico, Andrés Manuel López Obrador, the president there, further to the left than any modern Mexican president that I can think of. That doesn't concern you, it sounds like.
Well, it doesn't. It doesn't. In general, no, it does not. I'll tell you why. That what he's going to do, and there's been a lot of talk. I talked at Beaver Creek in the Denver Gold Shows. I learned a lot about what's going on in Mexico. The bottom line is what they're getting very, very concerned about is doing it right and environmental stuff. And so, the message from the government has been, we're cracking down on mining that's dirty. And, so you've got to, the Mexican government derives enormous inflow of, it's like the number one industry in Mexico is mining. So, and they need that tax income. They need those royalty incomes. What they're doing is they're going to, the shady operators or the people who've been skating on the edge in terms of doing it in the correct way, they're going to crack down on that. But what I heard several of the Mexican people saying, Mexican miners that I met with saying is, they've said to us, look, you guys are doing it right. We're good with you. What this means is the people who aren't doing it right are going to have to come up to the standards that you guys have already done. And I know that James and Ramon, understand what those standards are. So I'm not too concerned about it.
So it really sounds like silver prices are the wild card in all of this.
They really are. Silver's a risk. I mean, no doubt. As you're probably aware, your listeners are probably aware, there's a lot of demand for silver, and it's growing. If we're going to do all this ESG stuff, if we're going to go to electric cars, we've got to have a lot of silver. And, it's hand to mouth. There's not a huge stockpile of silver out there in the world.
It sounds like even the dogs are excited.
Yeah, I got my dog. I got my dog chiming in. I apologize for that.
And then your time horizon for Guanajuato, this is a junior producer.
Yeah, I think it could. I think this could work in the next year or two pretty well. It's deeply undervalued, and they're making a lot of progress. I personally, because with all of these, I think the critical thing to do is to find good management. If the mining business is difficult enough, that without good management, your odds of a problem go up substantially. And I think you've got good management here, and therefore, I think all these you could hold for 5 years. There could come a time when the precious metals have run up substantially, and these things are not cheap anymore. And at that point in time, I could see that happening 3, 4, 5 years out. At that point in time, they would not be as compelling as they are right now. But I think right now they're quite compelling.
And now the twist, it's called Three Ideas. But as you were talking to me and the creator of this show, executive producer Jillian Glickman, you said Three Ideas is irresponsible. Tell us what you mean by that in the context of the industries that you work in. And we're not going to hold you hostage to the show format or our community's show format. So we're not going to go as in-depth, but tell me why three just isn't sound in your mind here.
Yeah, I mean, so all of these companies have great asymmetry and great upside. Okay, which is to say that, if they work, they should be worth, multiples of their current valuation. You might say, well, why is that? And I'll tell you why. Because as I've mentioned many times, there's always, Murphy's Law of mining, which is things can go wrong. And so they also have the possibility that they can blow up. And if you go look at charts of mining stocks over the past 20 years, you will see that every now and then one of them kind of goes to zero or really loses a lot of value. It turns out to be an unmitigated disaster. And that happens with kind of frequency. I mean, and it's hard to know which ones would be. Obviously, we all knew you wouldn't buy those ones. And so even these good companies, occasionally something will go wrong. So therefore, I think it's irresponsible. If you're looking at these things, I believe what you want to do is you want to at least have 10 names and have your bets spread across those names, knowing that if one of them fails, the other 9 will probably work, and then they might go up 2, 3, 5x. And so the fact that one of them went to zero doesn't totally destroy your overall rate of return. So I've given you 3 good ones here, and as we were talking about, what I asked you to do is I wanted to be able to list kind of my next favorite 7. That go beyond that, and each one has different risks and rewards, but I think they're all very, very interesting situations. I own them in my fund, and I believe very much that they're good companies that will do well. And so I would encourage people to kind of look beyond just the highlight names. And I don't know, are you okay with me just reading them off?
Yeah, absolutely. I wish we could do everyone, but we don't have enough time for all that. But absolutely, I think people will be interested to know these names.
These are other names that I really strongly believe in. I think the management team's good. I think the deposit's good. I think the upside is good, et cetera. So just start with Ayu Silver and Gold. It's an amazing deposit in Morocco, just amazing. A huge, huge silver deposit, one of the largest in the world, run by Benoit Lassalle. He built Semifo. I love it. I mean, I think it was almost one of the 3. Another one is I-80, which was actually a spinoff from Premier and Equinox. It's out in Nevada, a very safe area, fantastic management team. They're going to daylight a ton of value. Another one is GCM/Aris. GCM stands for Grand Columbia Mines. The ticker symbol is GCM. They are merging with a company called Aris, A-R-I-S. GCM is trading at 3 times cash flow. They've got an amazing development pipeline. I love it. It's a great company. Another one is K92. They're over in the Ring of Fire, and they have probably the best operating mine in the world today in terms of grade, performance, growth, and management team. It's just I've owned it since 80 cents. It's at $6 now or something. Just an outstanding situation. 2 more, Silver Corp, which is the cheapest silver company in the world. This is an amazing story. 400 million market cap, 200 million cash, 100 million in marketable securities. So enterprise value is 100 million. EBITDA is 100 million. Trading at 1 times EBITDA. You might say, why is that? I'll tell you why. It's because the mine is in China. And so the company's headquartered in Vancouver, but the mine is in China. Everyone's afraid that we go to war with China. They grab the mine. So, but does that really make it 1 times EBITDA the correct number? I mean, what we were joking about out at Beaver Creek is, you could short Apple and go long Silver Corp and you'd have a nice pair trade. Because if we go to war with China, Apple's going to zero. I mean, since they do all the production in China. So, and then the final one is a nice development story in Canada called Cassiar Gold, Cassiar Gold. Really great team, great deposits. They're developing a mine. They've got, a lot of property and so forth. So, I mean, these are all companies that I own and believe in very strongly. And there are more beyond that, but those are kind of the ones that were close to the top of the list.
Well, Larry Lepard, it's been great getting to know you and to hear the ideas that you have here. And also your global macro outlook, I think, is really interesting to hear in terms of the industry that you're looking at. So thank you very much. And when you have 3 more ideas, we'd love to hear from you again.
Yeah, I'm most welcome to do it. Enjoyed it. Thanks, Sammy. Ask great questions.
Well, here are my takeaways from that conversation with Larry Lepard. First of all, that big picture outlook that he set out at the very beginning, I think, is the most important. You heard that he's had real pain in this industry and in his own fund for the past couple of years. Now he sees this as an opportunity to get in. The first idea that he talked about was Equinox Gold. This company, he feels, is solid in part because of where they're operating. The US, Canada, Mexico, and Brazil, he sees those 4 countries as geopolitically safe. His time horizon is about 1 to 2 years because this is a producer company in part. Conversely, the second idea that he had is about Osisko. Now, this is a development story. He talked about them developing in Quebec, in Canada. He has big faith in the leadership there. He called them Canadian mining royalty. But because this is a development story, he sees the time horizon there as longer than his first idea. He sees about 5+ years. One major risk that he sees there is CapEx, capital expenditures, in part because of the inflationary environment that the entire world is in, but that puts particular pressure on this industry and this project. And the third idea he had was from Guanajuato Silver. That's another Canadian company, though operating in Mexico. I thought what was interesting there was, again, the time horizon. He sees 1 to 2 years because it's a producer company. And like Brazil and Mexico, of course, there are people who might hear Latin American countries and paint them with a broad brush. He's saying that's a mistake. He thinks that Mexico is a safe bet, geopolitically speaking. I'm really glad we could do the first edition of the show with Larry Lepard. He's exactly the type of voice and really industry insider who has those connections, so he can bring us the type of insight that not just anybody can have in this type of space. Whether it's 3 ideas or We Got the Message, the new shows that we're bringing you here at Real Vision are a response to what you've told us you want. You want actionable, you want interactive, and these new formats really mean that you can squeeze even more juice out of every single idea at Real Vision.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.